Good morning.
Good morning, James.
And you've got transition on your slides, which is, yeah, I have to navigate. It's fine. It's good.
Oh dear, I'm terribly sorry about
that.
No,
don't worry about that. Don't worry. It's all cool.
Well, that's
so we
good.
brought this slide up first. It's important for everybody to read the small print. So there it is. I know you probably don't have time to do it properly, but you can always go back and watch it on the recording if you want to go back and read it, the whole thing. But I'm going to start off with the usual question and get you to talk a bit about what the fund is trying to achieve, please.
Well, before I do that, James, first of all, thank you for having me on, and thank you to everybody for tuning in. Your introduction there and your roundup of news just reminds me why I've enjoyed my 30+ years in the investment trust sector. It's full of intrigue, sometimes good, bad, and sometimes ugly. But you know what a wonderful, diverse sector it is to provide lots and lots of investment opportunities to investors. Hopefully, I'm going to talk today about Witan being something that is neither good, bad, nor ugly, or indeed full of intrigue, and something that forms the cornerstone of lots of shareholders' portfolios. So what is Witan all about? Witan was launched well over 100 years ago now as an investment vehicle for one individual family. 100 and something years on, we now have well over 20,000 shareholders and nearly £2 billion of assets. Our rationale, or our purpose, if you like, is to significantly grow our shareholders' wealth over the long term by investing in global equity markets through a multi-manager approach. Witan is unusual in the investment trust world in that we are self-managed, which means that I and my colleagues are employed by Witan, and we work under direction from the board to identify a group of managers who are specialists in their fields, and we put those managers together to create a portfolio which we believe forms a good cornerstone for our shareholder portfolios. The fact that we're self-managed, we believe, is important because it means that we're 100% focused on Witan. My colleagues and I don't have a suite of lots of funds to manage or to go and market, etc. We have one product, so we're absolutely focused on that. And of course, being self-managed, our shareholders are ultimately our employers as well. So 100% aligned, we believe, with our shareholders. Just focusing on the nuts and bolts a little bit here, and I won't go into too much detail at this stage. Very happy to answer questions. But we are not a fund of funds. We are a multi-manager structure, and that's important because our assets are held in our own custody. We don't invest into funds run by other managers. Typically, we do have one or two, but the vast majority of our assets are held in our own custody. So we have absolute control over those assets. We can never get gated, for example. If you think back to the Woodford scandal where people couldn't get their money out of funds, that can't happen to us because we would just take those assets and reallocate them to a different manager if we felt that that was something that we needed to do. Also, we have full transparency over our portfolio. So, for example, last week when the news broke about Silicon Valley Bank, we were able to look real time into our portfolio and see, okay, have any of our 8 managers got exposure to that company, or what is our exposure to similar companies? So absolute transparency, which we believe is very helpful for risk control as well as for understanding how our managers think and operate. Let's move on, James, shall we, to the next slide to talk about the portfolio structure. Oh, we got one too far. There we go. So thinking about how we structure the portfolio, first and foremost, we think about who our investors are, who our shareholders are, and the vast majority of our shareholders. Sorry, I know I'm speaking quickly, but I'm trying to canter through here because there's quite a lot to cover. I want to leave lots of time for Q&A. A lot of our shareholders are individuals, and Witan forms quite a significant part of their portfolios. So we build the portfolio to suit that investor base. The core portfolio, which is approximately 75% of our assets, is allocated to managers who invest In developed markets, typically in developed markets around the world, they do have the ability to buy into emerging market companies, but typically they'll buy into developed markets. Those will be mega cap, large cap, and sometimes mid cap companies. And typically our managers will look for companies that have enduring cash flows, sustainable revenues, underappreciated growth prospects, and occasionally, sometimes, or more than occasionally, into sometimes cyclical businesses which are undervalued. Currently, there are 5 global managers and 1 UK manager covering that part of the portfolio. But we recognize that those sorts of more generalist managers are often unwilling or unable to invest into some more specialist parts of the investment universe. So that's why we have a specialist portfolio or a satellite portfolio, which invests in areas or themes which have potentially higher growth prospects, or they might be cyclically undervalued for whatever reason. So I noted James's point earlier about the launch of investment trusts are often done at the peak of a cycle. Well, quite often we can use this portfolio to invest into investment trusts that are at the bottom of the cycle. And a great example of that is BlackRock World Mining Investment Trust, which we bought into in 2014, admittedly a year too early, but at the bottom of what was then a commodity cycle, and have obviously enjoyed the returns since then. But this also gives us exposure to things like emerging markets. We have an investment in a climate change strategy, and through listed investment companies, we can invest into private equity and life sciences, and other opportunities. So let's move on a page. This just gives you a very broad overview of how Witan is structured. We have the board that delegates many of the day-to-day responsibilities to us, the investment team. We are responsible for overseeing our investment managers, of which there are 8 at the moment, and the board and the investment team is responsible for the appointment and oversight of those managers. And then those managers obviously have a lot of investment managers and analysts within their organization. So buying a share in Witan gets you perhaps 100 or more investment individuals who are overseeing your portfolio for you. And there we go. We've got the portfolio in numbers there, 8 different managers. We've got 235 companies in the portfolio. So each manager's portfolio is quite concentrated, typically between 20 and 40 holdings in each portfolio. And that gives us what is called an active share of 79%. Active share is a measure of how different a portfolio is from the benchmark it is aiming to outperform, with 100 being totally different and 0 being exactly the same. So our portfolio is quite idiosyncratic and quite different from the benchmark, which we believe is important, because to beat a benchmark, you've got to be different from it. The portfolio is spread across 11 different sectors and in companies domiciled in 26 different countries. So broadly diversified in terms of risk by sector and by country. And as I mentioned, we've got 12 specialist funds in the portfolio, giving us exposure to all those opportunities that sit outside the mainstream. Moving on, James. I won't go through this in detail, but I think it's the most important points on this slide is that when we think about employing a manager, we do so thinking about what they have built their career doing. So, we wouldn't select a manager to do something, where they've got a proven track record doing one thing and we ask them to do something different. We very much want to pick managers who have got a proven track record doing something that they're good at. Typically, those managers are very sort of high conviction. They'll every stock in their portfolio should count towards the returns that they generate. And beyond a few minor restrictions, such as they can't have more than 10% of their fund in any one company, and they can't gear their portfolios and they can't hedge them. Those are about the only restrictions we place on our managers. So what happens, therefore, is that Witan's overall portfolio becomes molded and becomes the result of the individual manager's stock selection. And one of our key roles is to oversee that and make sure that the combination of our managers gives us a portfolio that operates, that functions well as a unit. And the other thing I would point out on this slide is, of course, with our contacts and our network, we're able to identify managers throughout the world. We're not just limited to the UK, and currently we have 4 managers domiciled or based in the States and 4 in the UK, giving us access across the world equity markets. Let's go on, James. These are the list of our managers at the moment. As I say, there are 6 in the core and then the specialists. The core making up 75%. Going through the list in order of kind of highest growth to most value. Jennison runs 6% of our portfolio. They're a manager based in Boston. That typically identify high growth, high quality businesses and companies that are really at the peak of their growth trajectory. We appointed them a couple of years ago with 4% of our assets, and we've added to them a couple of times. They're now 6%. We've added to them as growth as a theme has underperformed quite significantly. So at points of stress, that's given us the opportunity to add to that manager. The next one is probably WCM. They are based in Laguna Beach, California. Again, a manager who focuses on high quality growth companies, technology, healthcare, 1 or 2 financials. Next one on the list, Lindsell Train. Sure needs no introduction at all. Lindsell Train have been running money for Witan since well over a decade now. But we changed their mandate at the end of 2019 from being a UK mandate run by Nick Train to a global mandate run also by Nick, but the lead manager on the strategy is Michael Lindsell, who works now with James Bullock as well, who's and Lindsell Train has strengthened the team away from just the 2 lead individuals. I'm sure that strategy needs no introduction, but focusing on brands and on the high quality businesses with predictable recurring revenues. Veritas is the next on the list. They look for quality companies that are cheaply or that are undervalued quality companies. And then finally, Lansdowne. Lansdowne are quite adaptable, and at the moment they give us quite a lot of exposure to undervalued cyclical businesses such as banks, materials, and airlines, and various other more capital intensive industries. I won't go into huge detail on the specialist portfolio because it's there in black and white, or indeed in pink and blue. I will just pause on to the GMO strategy, which I think is particularly interesting. It says climate change. This isn't about trying to identify, next year's winning technology, whether it might be hydrogen or whatever else. GMO was set up by Jeremy Grantham a few decades ago. Jeremy's a well-known value investor, and this strategy, he's also a very well-known environmentalist. This strategy looks to profit from companies that are well placed to benefit from efforts to mitigate and adapt to climate change. So it could be solar power, it could be wind, it might be a commodity miner, it could be a producer of materials that goes into battery technology, or indeed the energy transition, but also things like fertilizers, because of course as climate changes, yields drop and fertilizers become more a greater requirement. So it's a very broad approach to climate change, and it's been a wonderful strategy for us to be invested in for the last few years, and we're fully intended to be invested in it for the long term. Let's go on, James. Just a brief pause on responsible investment. I'm really happy to go into lots of detail on this if people would like, but I mean it will come as no surprise to anybody that the ESG in its broadest sense is continues to be high up the news agenda. We believe it's a great investment opportunity, as well as a risk control function and indeed part of our social responsibility as investment managers. But we don't believe there's a trade-off between investing responsibly and generating good returns for our shareholders. In fact, done correctly, the two go hand in hand. What I will say on this slide is that we have committed to have a portfolio that's full of sustainable businesses by 2030. To meet that commitment, we had to define what we see as a sustainable business, of course, and we put that under 4 different pillars: prosperity, people, planet, and partnership. And together with our investment managers, we've analysed every company in our portfolio to see where they are on that journey to being more sustainable over time. I think we can probably go on to the next slide. And I'm going to pause for thought in a minute. But so the end product of all those different inputs is a portfolio that you can see on the left-hand side that's diversified by geography. North America is the largest allocation in the high 30s%, UK about 20%, Europe about 21%. It's worth re-emphasizing that our asset allocation is the result of our managers' stock selection. So although obviously we have a view on where asset allocation should be, and I can talk a little bit about how we can adjust allocation later on, this is the result of stock selection, and happily it coincides with our view of the world that equities domiciled in the UK and in Europe remain undervalued and potentially a better investment opportunity than those in North America. Even though, of course, valuations have come down in North America, we still feel that European and UK counterparts offer better value at the moment. In terms of sector spread, you can see there it's pretty evenly spread across most of the major sectors around the market. Going on to the next slide, we can see the top 20 holdings. Now there's 230 companies in the portfolio, so I wouldn't put too much emphasis on the top 20, although the top 20 does account for 33% of the portfolio. One caveat is, of course, the number 1 position is GMO Climate Change Fund, which has 100 underlying investments in it. So at 6%, that probably is making more of its dominance than it should do. We have a number of our what we call direct holdings in investment companies in the portfolio in the top 20. They're starred there with an asterisk. So Apax Global Alpha is a private equity vehicle. So is Princess Private Equity. BlackRock World Mining I mentioned. In addition to the GMO Climate Change Fund, we've got an investment in VH Global Sustainable Energy Opportunities, which is another fund which looks to benefit from increased spending on the energy transition. And Syncona there at number 14 on the list is a life sciences investment company, which we have been invested in for quite a while, although initially it was a much bigger position than it is now because we took quite a lot of profit out of that when the shares were trading at quite a significant premium to asset value. I'm sure the rest of the names on the list need no introduction whatsoever. There's a smattering of banks, of technology companies, consumer goods companies, and indeed things like transportation as well with Canadian Pacific Railway. Moving on. How are we doing for time, James? Am I all right?
We're not too bad.
Okay. Should we do a couple more slides and then I'll hand it open?
Yeah, sure.
I'll whiz past the ESG and numbers. I mean, basically the bottom left chart shows you the outcome of our exercise that we carried out with our managers. It shows that the vast majority of our companies are doing very well in terms of our assessments of their sustainability, but obviously there's more work to be done over the next few years. Moving on to the next one.
Your carbon intensities breached the line there.
Yes.
People going back into sort of oil companies, or what's happened?
Very, very observant of you. Absolutely. 2 or 3 of our managers at the end of 2021 and the beginning of 2022, and indeed in the wake of the Russian invasion of Ukraine, increase their weighting in oil companies. We've always had a very low weighting in oil companies, kind of 1 or 2%. By the time we got towards the beginning of the fourth quarter of last year, that number was up to about 5%. So obviously the impact of that is to increase the carbon intensity of the portfolio. It's also worth stressing that when we talk to our managers about the carbon footprint of their portfolio, or indeed ESG in general, we're very much focused on the evolution that the companies are going through, rather than trying to. We don't impose any restriction on our managers and what they can invest in, apart from they can't invest in controversial weapons. And we think it's important that that they're able to invest in companies that are doing real good, even if right now their carbon footprint might not be. So actually, in our annual report, we put in a case study about engagement with ArcelorMittal Steel, which is obviously a steel manufacturer, steel being the worst industry in the world probably for carbon emissions. But companies like Arcelor are making great strides, and they invested I think it was €1 billion in Spain this year or last year, to try to develop out a greener steel plant, so they can be the solution to the problem as well as a contributor to it. So that's what we think about when we think about our transition to a more sustainable portfolio. Is I think companies that like that are really set to benefit from investments they're making today, because people will pay a premium for better quality steel over time.
Just to clarify something, are you voting the shares, or are the underlying managers voting the shares?
Managers.
Right. Okay.
So we outsource the selection of stocks to our managers. It makes no sense to us not to outsource the voting as well, because they're the people who know the companies intimately, and they're the people who also engage with the companies as well. We don't outsource engagement. We believe that it's our managers who should do that.
Cool. Okay.
I'll just quickly touch on this. I mentioned that we have various tools that we can use to adjust asset allocation if we feel that the stock selection needs a bit of tweaking. But also we have other tools we can use to help drive performance. So gearing is the most obvious. Witan is fortunate to be of significant size, and therefore we've been able to issue long-term fixed rate. They're actually called private placement notes, but you can think of them as bonds. And the longest maturity is to 2054, so very long dated, and the average coupon is 3%. So we're borrowing at a significantly cheaper rate than the UK government, and that's, we believe, very advantageous to our shareholders. And that's £155 million. We didn't want all our gearing to be in fixed rate long-term debt, because that gives you less flexibility. So we do have short-term variable rate debt as well.
That's good. We talked about that last week, actually.
Oh, did you?
Alliance and FTSE, not yours, but the same thing, really. I mean, 2054, I would say 3%.
3%.
Yeah, it is cheap.
So just as an aside, yeah. So when the what did they call it? A fiscal event. The mini budget came out at the end, last year. Bond yields in the UK, went through 5%, and actually we were able to go and buy gilts at that point, because we felt that we were borrowing at 3% to 2054, and we could invest that at 5% on a similar tenure. And obviously what happened is the Bank of England came in and said, they'll do whatever it takes, and so what was potentially a long-term investment became a short-term trade. But that gives you an idea of how flexible we can be. We're able to take advantage of those sorts of situations.
Cool. Okay.
All right. Buybacks.
Yep.
No, that
was dividends first. Sorry,
we were on the previous slide.
Oh, sorry. Yeah. There we go. Back again. Yep. Sorry.
The board has always said that it seeks a sustainable low discount or premium to asset value, and when shares trade at a discount, we'll buy them back. And so we've been quite active in buying shares back. We believe it's our obligation as a company. We believe it's good for our shareholders, It helps to limit the discount. It certainly helps to remove discount volatility. And more importantly, it provides an uplift to the remaining shareholders. So just as an example, last year we made £11 million through share buybacks, which pretty much offset all the ongoing charges for Witan. So that just puts it into perspective, the amount that can be generated through assiduous use of share buybacks.
Good.
And I'm just going to talk about dividend and then we'll hand it open.
Sure.
So progressive dividend policy. The dividend has increased every year since 1974. Because it's the Cheltenham Gold Cup today, I thought I'd look to see what happened in 1974, and it was the year that Red Rum won his second Grand National. And for the musically minded, it's also the year that ABBA won the Eurovision Song Contest with Waterloo. So there you go, 48 consecutive years. The board is obviously very mindful of that and is committed to continue to increase the dividend. It's supported by revenue reserves at times where there is a revenue shortfall, and clearly, 2020 through to this year, companies are still recovering from COVID. So there has been a bit of a revenue shortfall in the last couple of years. But as you can see there, 35% up this year versus last. The cover is rebuilding quite rapidly. And I'm going to pause there, James, because I'm sick of the sound of my own voice, and I'm sure people are probably sick of the sound of my own voice as well.
Cool.
Really happy to open it up.
Yeah,